the way we recommend answering these questions is to do it in a flow that makes sense. Okay, so what does that mean? That means that typically we always want to start from the income statement, okay, regardless of whether it actually affects the income statement or not, because some transactions actually don't affect the income statement. But if it affects it, even if it doesn't affect the income statement, we always start from the income statement and just say, there's no changes to the income statement. Hey guys, if you like the content on this episode today, I want you to go and click the subscribe button to make sure that you get all of our future episodes as well, because we're putting out these episodes multiple times a week to make sure that we help you get into the top investment banks in the world. Okay, today I want to talk about the most common mistakes that we see when students are trying to answer 3 statement questions. Okay, by 3 statement questions, we're talking about the 3 financial statements. Most of you should know what that is already. If you don't, it's basically when an investment banker is testing you on your accounting knowledge, okay? And the 3 financial statements are the income statement, the cash flow statement, and the balance sheet, okay? So these are very common questions that you're going to get in technical interviews, because accounting and the 3 financial statements in general, or knowing how to read the 3 statements, that's the foundation to everything else you need to do as far as technical interviews go, right? Like if you don't know the 3 statements, you're not going to be able to know valuation methodologies. If you don't know the 3 statements, you're not going to understand merger math. If you don't know the 3 statements, you certainly can't do leverage buyouts or LBO models, right? And so what are the 3 most common mistakes? Well, so the tricky part about the 3 statement questions is that they typically want you to talk about the impact on all 3 statements, right? And one of the most common mistakes that we see actually is that a lot of students will only talk about the balance sheet, okay? And the reason why they'll only talk about the balance sheet is because when they were in accounting and school, they were taking an accounting class, the balance sheet was what the teacher focused on, right? What your professor was mostly talking about. It's like you're learning how to do debits and credits. You're learning how the P ledger balances. So you'll say, oh, well, when this type of transaction happens, you debit cash, credit inventory, or you debit cash and credit accounts receivables, right? Like, so that's how you're wired to talk about this stuff, just from the schooling that you received. But in reality, that's actually how accountants typically talk about accounting. It's not how investment bankers talk about accounting. So if you want to be an investment banker, you're going to have to speak the investment banker's language, okay? So that's the first mistake, is only talking about the balance sheet and using terms like debit this and credit that. Like, no debits and credits, okay? That's not what they're looking for in these types of answers. Second thing is, somewhat related to that, not addressing every single part of the transaction, right? So for example, some of these 3 statement questions are actually multi-step questions, okay? So they might seem like it's just one business transaction, but one business transaction can have like basically multiple downstream effects on the financial statement. So for example, they might say, hey, what happens if you buy a piece of equipment for $100, right? The most obvious example, or the most obvious part of the answer to that is, oh, cash is going to go down by 100, and your plant, property, and equipment is going to go up by 100, because that's how much you bought the equipment for, right? But there's actually second order and third order consequences to that, right? Like, once you buy the equipment, what they're also testing for is, like, do you know that in the future years you're going to have to depreciate this piece of equipment, right? So in year 0, at the time of the purchase, yeah, it's just cash going in, cash going out and equipment coming in, right? Then after the first year, you use part of the equipment, you actually have to depreciate it based on, well, whatever the useful life is, right? If the useful life to the equipment is 10 years, then you would depreciate it, 1/10 at a time, right? So if it's $100, after a year, you're going to depreciate $10 of it. So next year, depreciation is going to go up by $10, PP&E is going to go down by $10, and then how does that flow through all 3 statements, right? That's actually like an easier example. Like $10 of depreciation flowing through the statements is like the classic 3 statement question that everyone should know how to answer at this point. But it could get much more complicated than that, right? They could also say, let's say you take on debt to buy a piece of equipment. Now they're adding a wrinkle to it, but you have to specifically address the fact that they're using debt to buy this piece of equipment, right? Now, if they use debt that's going to affect the cash flow from financing section. And also, it's going to affect your interest expense on the income statement, on top of everything else we already talked about, such as depreciating the asset, right? So making sure you really address every single part of the transaction and cover all the moving pieces is really, really important. Okay, and then that leads me to my third point, which is actually kind of related. So like a lot of people say, well, how do you do that? How do I make sure that, I'm addressing every single piece of the transaction? Well, it could be hard, and most people are not good at this because they don't have like a framework for how they answer these questions, and they're not staying organized, right? So the way we recommend answering these questions is to do it in a flow that makes sense, okay? So what does that mean? That means that typically we always want to start from the income statement, okay? Regardless of whether it actually affects the income statement or not, because some transactions actually don't affect the income statement. But if it affects it, even if it doesn't affect the income statement, we always start from the income statement and just say, there's no changes to the income statement. That way you're telling the banker that that there's no changes to the income statement. It's not just because you forgot about the income statement, right? So you always start with the income statement, then you go to the cash flow statement, and then we always do the balance sheet last, okay? And the reason why we do that is because if you go down the income statement, you're starting from revenue and you're subtracting out all the expenses and you're getting to net income. That's the last item on the income statement, right? But the last item on the income statement actually becomes the first item on the cash flow statement because net income is the first on the cash flow statement, right? Then from there, you make all the adjustments to all the cash inflows and outflows during the period, and then that gets you all the way down to the last line of the cash flow statement, which is a net change in cash. How much did the cash balance increase or decrease by during this period of time? And guess what that does? That gives you the first line on the balance sheet, right? And the first line on the balance sheet is your cash balance. So if you just calculated the change in cash balance and you know what your previous cash balance is, now you can calculate what the new cash balance is for the current period ending balance sheet, right? Then you work your way down the balance sheet, and then the last thing you do, the reason we do the balance sheet last is because then you can see whether the balance sheet actually balances, right? You need your assets to equal to your liabilities plus your shareholders' equity. So if after you've taken all of your transactions into account, your balance sheet doesn't balance, then you know you made a mistake. So the balance sheet doing it last, it's almost kind of like a check for, whether you missed a step in between or something. Because if you did, I guarantee you it's not going to balance. Okay, if it does balance, still doesn't 100% mean that you didn't miss anything, but more often than not, most likely you didn't miss anything. Okay, and then I'll give you a fourth bonus one. A last mistake that we see a lot is just not asking questions about the missing information, right? So sometimes the banker will deliberately give you incomplete information because they want to see if you truly understand this thing conceptually, right? If you understand the three statements conceptually, you will know how to ask the right questions. You will know what's missing. You'll ask them for certain things. Like, for example, to calculate net income, you need the tax rate. Maybe they deliberately didn't tell you the tax rate, right? Or maybe to flow the depreciation through the three statements, you need to know the useful life of the piece of equipment that you bought. And they didn't give that to you, so you have to ask for that. Don't just assume things, right? If they didn't give you an assumption, don't just assume that it doesn't exist, or don't just assume your own number for it. Ask the interviewer what you should assume for it, okay? Because that's part of what they're testing on, okay? So anyway, hopefully that helps you. Those are the 4 most common mistakes that we see with 3 statement questions. And if you make sure that you avoid these 4 mistakes, you'll be well on your way, okay? Hey there, I hope you enjoyed this video. If you're looking for more customized advice that's tailored for your specific situation, then I invite you to book a free strategy session with our team at the link below. We'll talk to you soon.